Performance comes to the market. The bubble in the concept stocks. With conglomerates chattering about them, the managers of the investment funds found another magic word: performance. Obviously, it would be easier to sell a mature fund with stocks in its portfolio that went up in value faster than the stocks in its competitors' portfolios. And perform some funds did at least overshoot periods of time. Freight carries highly publicized enterprise fund raised up a 117% total return, including both in dividends and capital gains, in 1967, and followed this with a 44% return in 1968. The corresponding figures for the Standard and Poor's 500 stock index were 25% and 11% respectively. This performance brought large amounts of new money into the fund. The public fund is fashionable to bid on the jockey rather than the house. How did those jockeys do it? They concentrated the portfolio in dynamic stocks which had a good story to tell. And at the first signs of an even better story, they would quickly switch. For a while, the strategy worked well and led to many imitators. The camp followers were quickly given the accorded go-go funds, and the fund managers often were called youthful gunslingers. Publics invest dollars flowed into the riskiest of the performance funds, and so performance investing took hold of the Wall Street in the late 1960s. So the commandment for the fund managers were simple: concentrate your holdings in a relatively few stocks and don't hesitate to switch the portfolio around if a more desirable investment appears. And because near-term performance was especially important, investment services began to publish monthly records of mature fund performance. It would be best to buy stocks with an exciting concept and a compelling and believable story. You had to be sure the market would recognize the beautiful of your stock now, not far into the future. Hence, the birth of the so-called concept stock. But even if the story was not totally believable, as long as investment manager was convinced that the average option would think that the average option would believe the story, that all that was needed. The author Martin Mayer quoted one fund manager as saying, "Since we heard stories early, we can figure enough people will be hearing it in the next few days to give the stock a bounce, even if the story doesn't prove out." Many Wall Streeters looked on this as a radical new investment strategy, but John Maynard Keynes had it all spotted in 1936. Eventually, it reaches a point where any concept would do. Enter Kurt or Landell. His concept was a youth company for the youth market. He became the founder, president, and a major stockholder of National Student Marketing (NSM). First, he sold an image, one of influence and success. He owned a personal white Learjet named Snoopy, an apartment in New York, Waldorf Towers, a castle with a mock dragon in Virginia, and a yacht that slept twice. 12. Adding to his images was an expensive set of golf clubs propped up by his office door. Apparently, the only time the clubs were used was at night, when the office cleanup crew drove wads of paper along the carpet. Landell spent most of his time visiting institutional fund managers or calling them on the Skyphone from his lair, and he sold the concept of NSM in the tradition of a South Sea bubble promoter. Landell's real master was evangelism. The concept that Wall Street bought from Landell was that a single company could specialize in servicing the needs of young people. NSM built its early growth via the merger route, just as the ordinary conglomerates of the 1960s had done. The difference was that each of the constituent companies had something to do with the college-age youth market, from posters and rackets to sweatshirts and summer job directories. What could be more appealing to a youthful gunslinger than a youth-oriented concept stock or full-service company to exploit the youth subculture? Glowing press release and Landell's earnings projections for the company became increasingly optimistic. The following table clearly shows that institutional investors are at least as adept as the general public at building castles in the air. So I'm sorry for this cannot sharing the table, but the table shows me in National Student Marketing, some 4-season nursing centers of America performance system, the high price, the earning multiple at high, the number of institutional holders, year and 1968, low price, percentage decline, and so on. Okay, let's see the next paragraph. Other popular concepts include the 4 seasons nursing centers. The company explained it at a feverish pace, financing itself largely through the insurance of debt. These borrowings were sweetened, however, with a so-called equity kickers. This meant that attached to each bond were warranties to buy common stock of 4 seasons at fixed prices. Thus, if the stock prices continued to go up, the bondholders could exercise their warrants and make additional profits. As the debt mounted, no one seems to worry much about the old ideas of prudent debt ratios, for this was a new concept and the rules of the game had changed. On June 26, 1970, the company filed a petition for reorganization under Chapter 10 of the Bankruptcy Act. My favorite example involved the mining pearl. Mining Pearl was a fast food franchising firm that was accommodating as all get out. To please the financial community, Mining Pearl's chickens became the performance systems. After all, what better name could be chosen for performance-oriented investors? On Wall Street, a rose by any other name does not smell as sweet. There's unlimited shown in the table under price earnings multiple in the castle, that the multiple was infinity. Performance systems had no earning at all to divide it into the stock's price at the time it reaches its high in 1968. As the table indicates, the mining pearl laid an egg, and a bad one. That the subsequent performance for this and other stocks listed was indeed truly remarkable, although not quite what their buyers had anticipated. Why did the stocks perform so badly? One general answer was that their price earnings multiples were inflated beyond season. If a multiple of 100 drops to a more normal multiple of 20, you have lost 80% of your investment right there. In addition, most of concept companies of the time ran into several operating difficulties. The seasons were buried, too rapid expansion, too much debt, loss of management control, and so on. These companies were run by executives who are primarily promoters, not sharp-penciled operating managers. Fraudulent practices also are common. For example, NSM Cortez Wendell pleaded guilty to accounting fraud and served 8 months in prison. The sore 70s, the 1950s. In the 1970s, Wall Street pros vowed to return to sound principles. Concepts were out and investing in blue chip companies was in. These were companies, so the thinking went, that would never come crashing down like the speculative. Favorites for the 1960s, nothing could be more prudent than to buy their shares and next relax on the golf course, while the long-term rewards materialized. There were only 4 dozen or so of those primer growth stocks that so fascinated the institutional investors. Their names were the familiar IBM, Xerox, Avon Products, Kodak, McDonald's, Polaroid, and Disney. And they were called as 1950. They were big capitalization stocks, which means that an institution could buy a good-sized position without distributing the market. And because most pros realize that picking the exact correct time to buy it is difficult, if not impossible, those stocks seem to make a great deal of sense. So what if you paid a price that was temporarily too high? Those stocks were proven growers, and sooner or later the price was paid would be justified. In addition, those are stocks that, like the family heirlooms, you would never sell. Hence, they also were called one-decision stocks. You made a decision to buy them once, and your portfolio management problems were over. Those stocks provide security blankets for institutional investors in other ways, too. They were so respectable, your colleagues could never question your prudence in investing in IBM. True, you could lose money if IBM went down, but that was not considered a sign of imprudence, as it would be to lose money in the performance systems or a national students marketing. Like greyhounds in chase of the mechanical rabbit, big pension funds, insurance companies, and bank trust funds loaded up on the 1950 one-decision growth stocks. Hard as it is to believe, the institution had started to speculate in blue chips. In the table below, I have listed the price-earnings multiples achieved by a handful of these stocks in 1972, as well as their multiples at the start of the 1980s. Institutional managers blithely ignored the fact that no sizable company could ever grow fast enough to justify an earning multiple of 90 or 80 or 90. The once again proved the maxim that stupidly well packaged can sounds like wisdom. So we're gonna see the table. The table show me some security, the name, the Sony, Polaroid, the McDonald's, some flavors, Walt Disney, the wallet, the Packard, the price earning multiple, the 1972, 1980s. When the stock market was whole began to decline in 1972, the 1950 mania became even more pathological, for as the market in general collapsed, the 1950 continued to command record earning multiples and on a relative basis. The overpricing greatly increased. There appeared to be a two-tier market. Forbes magazine commented as follows: The 1990 appears to raise up from the ocean. It was as thought all of the U.S., but Nebraska had sunk into the sea. The two-tier market really consists of one tier and a lot of rubble down below. What held the Nifty 50 up? The same things that held up tulip bulb prices in long ago, Holland popular delusions and the madness of crowds. The delusion was that the companies were so good that it didn't matter what you paid for them. Their inexorable growth would bail you out. The end was inevitable. The 1950 crisis ended like all other speculative manias. Sooner or later, the same money managers who had worshipped the 1950 decided that the stocks were overpriced and made a second decision to sell. In the decade that followed, the premier growth stock fell completely from favor.